Hello, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving deep into one of the most fascinating corners of the financial markets, commodities. Now, when we talk about commodities, we're talking about the essentials that power our world, precious metals like gold, energy sources like oil, and the agricultural crops that literally feed billions of people. Commodities aren't just numbers on a trading screen. They are real, tangible assets that impact everything from inflation and global trade balances to the cost of your groceries and gas. And here's what makes them so exciting for us as traders and investors. Commodities often behave differently from stocks and bonds. They bring diversification, they provide hedges, and when timed right, they can deliver outsized gains. So, in this episode, we're going to break down the outlook for 2026 across three core areas: gold, and how it stacks up against crypto as a hedge asset; oil, with a detailed look at the oil price forecast 2026; agriculture, and why ETFs in this sector may be one of the smartest long term plays in a world of climate volatility. Along the way, I'll also touch on where to look for the best gold mining stocks 2026, how to think about oil's role in portfolios, and why agriculture ETFs can give you exposure without the complexity of futures contracts. So grab your notebook or trading journal. This is going to be a detailed one. Segment 1: Gold versus Crypto. Which is the better hedge in 2026? Let's start with gold. Gold has been humanity's safe haven for thousands of years. From ancient coins to modern central bank reserves, gold has always represented stability and trust. When inflation runs hot, when currencies lose value, or when political risk escalates, gold usually shines. But over the past 15 years, something new has challenged gold's dominance: cryptocurrency, especially Bitcoin. Supporters call Bitcoin digital gold. Why? Because, like gold, it's limited in supply. There will only ever be 21 million Bitcoin mined. It's decentralized, not controlled by any government, and it's borderless. You can move it with a click. So here's the debate: is gold still the better hedge? Or is crypto the new standard? Let's weigh it out. Gold's advantages are clear. Central banks love it. In fact, between 2023 and 2024, they added over 1,000 tons of gold to their reserves. That tells us something. Institutions still trust gold more than crypto. Gold thrives during inflationary cycles. With inflation still sticky in parts of the world, gold demand remains strong. And perhaps most importantly, in times of crisis, whether it's geopolitical tensions, banking instability, or recessions, gold attracts flows from investors seeking safety. Crypto, on the other hand, has its own appeal. Bitcoin scarcity is programmed. That appeals to those who distrust fiat money and monetary expansion. Younger investors, millennials, and Gen Z, tend to favor crypto as their hedge of choice, seeing it as more modern and aligned with a digital first world. And of course, crypto's volatility means it has the potential for massive gains in a short period. But here's the issue: that same volatility makes it unreliable as a hedge. In 2022, for example, Bitcoin moved down with tech stocks, not against them. That's not what a hedge is supposed to do. So the verdict for 2026? Gold still dominates as the true hedge. Crypto can complement gold, sure, it can sit alongside as a speculative play. But it doesn't yet replace gold's role in conservative or institutional portfolios. Segment 2: Best Gold Mining Stocks 2026. Now, if you want exposure to gold, you can buy bullion, you can trade futures, or you can invest in mining stocks. And mining stocks are where things get interesting. Gold miners act as a leveraged play on gold prices. When gold rises 10%, mining companies can see their stock prices jump 20, 30, sometimes even more. But not all miners are equal. So what should we look for? Production costs. The key metric here is all-in sustaining cost, or AISC. The lower the cost per ounce, the better the profit margins. Reserves. A miner with decades of proven reserves in politically stable regions is far more attractive than one operating in unstable areas. Financial strength. Companies with healthy balance sheets and manageable debt are more resilient in downturns. Dividends. Some miners offer steady payouts, making them attractive not just for growth, but for income investors too. So, who are the big names? Newmont Corporation, the largest gold producer globally, diversified across continents, and a reliable dividend payer. Barrick Gold, another giant, with strong reserves in both North America and Africa, and a track record of disciplined cost management. Agnico Eagle Mines, known for operational efficiency and exploration upside. And then there are the mid cap growth players. These are the companies expanding production aggressively. They carry more risk, but if gold continues its upward trajectory into 2026, let's say pushing beyond $2,200 per ounce, these mid caps could turn out to be the best gold mining stocks 2026, delivering outsized gains. Segment 3, Oil Price Forecast 2026. Let's shift gears to oil. Oil is still the world's most important energy source, even as we transition to renewables. It powers transportation, supports industry, and feeds into petrochemicals that go into everything from plastics to fertilizers. So, what's the outlook for 2026? On the demand side, emerging markets are driving consumption. India, for example, is expected to see demand grow over 5% annually into 2026. Africa is also ramping up. On the flip side, developed markets, Europe and North America, are slowly reducing their oil consumption thanks to electric vehicles and stricter energy policies. Aviation and shipping, however, remain heavily dependent on oil, with very few scalable alternatives in the short term. On the supply side, OPEC Plus continues to manage output actively, cutting supply to keep markets tight. There's been a chronic underinvestment in new exploration. That means even if demand surprises to the upside, supply may not be ready, leading to potential price spikes. And of course, geopolitical risks, from the Middle East to sanctions on Russia, could easily cause disruption. So here's the forecast. Most analysts see Brent crude averaging between $80 and $100 per barrel in 2026. But with supply this tight, if a major disruption occurs, we could see spikes above $110. On the downside, a global recession or accelerated EV adoption could pull prices closer to $70. For traders, this means oil remains cyclical. There's real upside potential, but also volatility risk. That makes it a prime candidate for tactical trading strategies, or for diversified exposure through energy majors and oil ETFs. Segment 4, Agriculture ETFs. Feeding a growing world. Now let's talk food. Agriculture doesn't always get the same headlines as gold or oil, but it's arguably the most essential commodity sector. After all, we can live without gold jewelry, but not without food. Global demand is only going up. Populations are growing, incomes in emerging markets are rising, and diets are shifting toward more resource-intensive foods like meat, which requires grain. But supply faces big challenges. Climate change is making weather patterns more extreme. We've already seen droughts, floods, and heat waves disrupt harvests. Geopolitical risk. The Russia-Ukraine conflict highlighted just how fragile global wheat supply chains can be. Rising input costs, things like fertilizer and fuel, push food prices higher and squeeze farmer margins. So, how do investors tap into this space? Directly trading agricultural futures requires expertise and leverage that not everyone is comfortable with. That's where agriculture ETFs come in. Some of the more popular ones are the Invesco DB Agriculture Fund, ticker DBA, which offers broad exposure across grains and soft commodities. The Teucrium Corn Fund, ticker corn, for targeted corn exposure. And the Teucrium Wheat Fund, ticker WEAT, which focuses on wheat. These ETFs give you accessible, diversified exposure without the complexity of managing futures contracts directly. And in a world where climate disruptions are expected to intensify, agriculture ETFs could prove to be one of the most resilient long-term additions to a portfolio. Segment 5. Putting it all together. So where does this leave us as traders and investors looking into 2026? Here are the key takeaways. Gold remains the anchor hedge. Crypto is exciting, but it's not reliable enough to replace gold. For extra upside, look at the best gold mining stocks 2026, the companies with strong reserves, efficient costs, and growth potential. Oil is still central. The oil price forecast 2026 suggests stability with room for cyclical surges. Traders can capitalize on volatility through futures, ETFs, or energy equities. Agriculture is indispensable. ETFs in this space provide both inflation protection and exposure to one of the most critical sectors on the planet. Commodities aren't just diversifiers, they're foundational. They protect portfolios during uncertainty, and at the right moments, they lead them. Segment 6: Tools for Smarter Trading Now. Knowledge is one part of the equation, execution is the other. If you're looking for a world class, cutting edge, user friendly trading platform app, I highly recommend checking out crystalballmarkets.com trading platform. It's designed to help traders like you analyze and trade commodities, whether gold, oil, or agriculture, with ease and confidence. And if you're new to this space, or even if you just want a clear, beginner friendly breakdown of what's happening in the markets, you'll love their podcast series. Head over to Crystal Ball Markets Podcast on our ss.com. They cover trading, investing, macroeconomics, and global markets in a way that's simple, clear, and actionable. That's it for today's episode of Financial Market Insights for Traders. We've covered a lot: gold versus crypto, the best gold mining stocks 2026, oil's demand outlook and price forecast, and why agriculture ETFs are an underrated but essential play. Remember, commodities aren't just about speculation. They are real assets tied to the fundamentals of human survival and economic activity. They offer protection, diversification, and yes, incredible opportunities when approached strategically. Thanks for joining me. I'm Sophia, and I'll catch you in the next episode. Until then, trade smart, stay informed, and keep your edge sharp.